What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Happy Friday out there. We are going to wrap up the week with a fun Friday live stream. I got a question the other day from probably a new listener, new viewer, and asked me to go over my macro thesis because that's what my content is really centered around, a very unique macro thesis. So we're going to dive into that today. Let's share the screen and jump into it. Bitcoinandmarkets.com. That's my website. Free tier gets a free weekly newsletter every week. No spam or anything. You can support the content over there. And you can also sign up to get a premium tier. That's going to be stuff where I write all about different metrics, price, things that are happening in macro, and give a short-term, medium-term, and long-term price forecast for Bitcoin. So check out bitcoinandmarkets.com. I'm also writing, for the time being, over on bmpro.substack.com. You can also find that at bitcoinmagazinepro.com. So check that out. If you're subscribed over there, come and subscribe over to bitcoinandmarkets.com. That way you will never lose contact with me. Okay, so what are we going to talk about today? My macro thesis goes around 3 Ds: deflation, deglobalization, and depopulation. And they all are self-reinforcing on each other. So deflation is the first thing we want to look at. A lot of people going into COVID, first off, going into the great financial crisis and then QE and all that, they're all worried about inflation. And then the inflation never really kicked off. We started going back into recession in 2018 and 19. And then COVID hit and there was all this spending. We had a big push of stimulus. Of course, prices did go higher, but we also shut down all the supply chains in the world. So what percentage of that increase was due to inflation and which was due to supply chain issues? Overall, though, what we are looking at, this is just a brief period of time. The longer story is going back at least to 1971, and you guys probably all know what happened in 1971. We had, going off the gold standard, the elasticity of money was unleashed, and the whole world was built up. We had the Japanese miracle followed by the Chinese miracle, booms and busts along the way. But that is one giant 50 to 75 year credit bubble. And it was all enabled by global institutions, U.S. hegemony, things like the UN, WTO, World Court, World Bank, IMF, WHO. All of these things work together to provide this international system that enabled the growth of credit in a 50-year credit bubble. We are at the end of that credit bubble. And what happens in that end of that credit bubble? You're going to get deflation. Credit is going to contract. So we're going to get deflation. Also, the breakdown in trust of all of these international institutions. Of course, we know what's going on with the WHO. No one really trusts them anymore. The WTO, we have a story that touches on that today as well. The WTO is kind of breaking down. That's the World Trade Organization, for you guys that don't know. And the UN is not having the confidence of many people. Countries as important as India have said, what does the UN do, actually? Because it's not functioning anymore. So we have this deglobalization push, and we're going to have shrinking supply chains, more friendshoring and nearshoring, and that is all not good for credit. Okay, so credit is a deglobalization is a reinforcing factor into deflation. All right, and then the last part is the depopulation, and we're going to take a look at a story on that. Depopulation is for the first time in history, we're facing something like we're facing right now with a demographic decline. And the demographic decline locks in any future ability to growth. A lot of people say, oh, we have robots, we have AI, but you don't understand. You need to somehow supplement demand. So AI, yeah, maybe with automation and robots, we can continue producing, but you're going to produce for fewer and fewer people. And so you need to supplement demand somehow, or else it's all going to be malinvestment. It's like building bridges to nowhere. Okay, it feels good as some stimulus on your economy, but you got to pay for it on the backside, right? And so this depopulation is going to lock in these pressures of deglobalization and deflation. And what is the way to get out of that is the fourth and final part of this macro thesis, and that is Bitcoin. Bitcoin is a solution to the deflation problem and will break this reinforcing downward loop. So, okay, that all being said, let's take a look at the Bitcoin price first. So let's go to a live chart. And here we go. Let's go to the weekly, and then I'm going to bring up the 20-week moving average. And we're going to go to a line. That makes it a little easier to see. But what I'm comparing this period to right now is every period after a halving. So you can see if we go back to 2016, we had the halving. We struggled with the 20-week moving average for a while before we finally took off. Same thing happened here after the COVID halving. Struggled with the 20-week moving average, and then we really took off. And right here, we are once again right smack dab on the 20-week moving average. We're actually slightly above it now at 64,160, about $20 above where that 20-week moving average is. So this is an important period, and I do expect just a grind upward, slightly, up to the right, and then take off here later in the summer. So that is hopefully keep some people hodling that might lose their strong hands in this period. Maybe they bought just recently at the all-time high and they're thinking about selling. Maybe they bought the ETF and they're thinking about selling already. So this is what we expect, a shakeout after this, after the halving. And right now it's very, very bearish. The sentiment out there in Bitcoin is very, very bearish, but it is going to turn around before you know it. Another one I saw today, let's go to this one here. And this is a chart, CryptoQuant, who put this together. It looks like this JJC Moreno. I don't know if he put it together or if someone else. Oh yeah, he's head of research at CryptoQuant, so he probably put this together. But this is their bull bear market cycle indicator. When it gets red, it's overheated, and orange is bull market. If it is going into blue, then it's a bear market. So you can see there's no sign right now of any sort of bear market. We have consolidated simply back to the level that we saw back in September or August of last year. And that's interesting, this timing. I didn't notice this timing before, but let's go to, let's see if it's been published yet. It has not been published yet on BM Pro. So let me bring this up elsewhere. The one I wrote today. All right, so this is today's post that's going out for BM Pro. And I look at a specific time for Bitcoin. Let's see if I can find it. Okay, it's right here. Can I make this image bigger? As big as I can get it on Google Docs here. But we are touching the most important level on the chart since August of 23. So you can see all of these different moving averages. We have the 50, the 100, the 200 day. We also have the 20 week and the 200 week. I talked about this back then. I wrote, published charts with this convergence of all of these different levels. This was a very important period for Bitcoin back here. And breaking above this collection of levels was extremely bullish. Right now, we are facing the next point of most concern with these different levels. You see down here at the bottom, the RSI. This RSI got very, very oversold. We are not oversold yet, but it is, I think it's probable that we touch the oversold territory on the daily RSI. But you can see that it's not quite as clustered as it was back here, but this is still a very important level. Breaking the 20-week possibly getting down to the 200-day. I don't know if that's possible or not, but it is quite crowded right here. So if we can hold this level and turn around, Bitcoin is going to be off to the races. All right, back to my other stuff. Where am I at here? Okay. So that's the Bitcoin price. But let's get into the macro thesis more. So let's talk about the dollar. Sorry, I'm jumping screens here, but let's go back to the DXY. And I'm probably the only person in Bitcoin that was bullish the dollar. I was bullish the dollar going into COVID. We had a period here of 2020 where the dollar went down, and a lot of people were that I had debated back here in 2019. They're like, "Oh, are you going to change your opinions yet?" And I'm like, "No, this is just a reaction to all of the stimulus and stuff. It's going to go rocket back higher." And then, of course, we experienced the dollar wrecking ball. Let me get this 20-day moving average out here. And I was expecting us to go into a range. So this is the deflation part of my analysis. And let's just draw this kind of range bound that we've seen. Over the last couple weeks, the dollar has climbed, and it looks like it could break out of this pattern and go higher in this range. The dollar, not quite a dollar wrecking ball yet, but it is threatening. It is threatening that. Now, why would the dollar go higher? Well, because the dollar is the global reserve currency, and people need dollars to pay back dollar-denominated debt. In a credit bubble, when it starts popping, people need dollars to service their debt so they do not default. And so the dollar, we get a dollar shortage. So if we are going into recession, if the global economy is starting to buckle here, there is going to be a dollar shortage. And we see this all around the world, actually. So here's the JPY, Japanese yen, and they intervened right here. Let me get my arrow. They intervened right here with like $60 billion to try to save it. That worked for a couple weeks here, but it is right back at the highs, 159 right now, breaking higher. This is very, very dangerous for carry traders. It's very, very dangerous for the global international finance. We saw a major bank in Japan say that they need to emergency dump a bunch of treasuries this week to meet, their margin calls basically on a lot of their carry trades and things. So that was a very big carry trading bank, and they are hurting. So that is probably the first of many that we will see, especially in Japan. We probably won't see them from China, but we will see them from Europe as well. Let's take a look at the euro. The euro now would be reversed of that. So going down is weakening, where the Chinese yen going up is weakening. But you can see on this chart, I pointed out end of Q3 was the low here. End of Q3 was the low here. We are still in Q2, but we're going into Q3 here pretty shortly. So this will start to push down. I think maybe get into parity towards the end of Q3. This would be symbolizing a strengthening dollar if the euro is going down versus the dollar. Okay, so that is the deflation piece that we covered. And now let's get into the deglobalization piece. So here we have a story from Zero Hedge. EU tariffs of up to 38.1% on China-made EVs are about to take hold. It will only be days now before tariffs of up to 38.1% go into effect on EVs shipped from China to the EU, the culmination of a months-long inquiry into how Chinese-made EVs have impacted the European auto market. As we noted days ago, SAIC is being hit with a 38.1% tariff. Okay, we talked about that. EV makers that cooperated with the probe but weren't in the three-company sample will face an additional 21% duty, while uncooperative firms will incur the full 38.1%. European brands like Mercedes-Benz, BMW, Renault, which export China-assembled EVs, will also face extra tariffs, according to Xi Jinping. China's Ministry of Commerce criticized the decision, stating the EU ignored facts, WTO rules. So this is where I said WTO is going to come back in. International institutions losing their credibility, and just the fact nobody wants to use these rules anymore. So, yeah, this was mentioned specifically by the Chinese here, and they were just let into the WTO 20 years ago, and now they're complaining about it. So, and the objections from the China EU member states. Beijing vowed to protect Chinese companies' rights. All right, so deglobalization. Everywhere we look, it seems there's more tariffs going up. There's more lack of trust in international institutions. And what happens to global credit markets when that happens? We get a reinforcing of a dollar shortage, a reinforcing of deflation. Now, this is deflation specifically if you're holding dollars. It's not deflation if you're holding euros or yen, as you could see by those charts before. Okay, so that was deglobalization. Let me check the comments and see if anybody is chatting up a storm here. Let's see. John Delaney, what's up? Have I listened to the Trump interview? That was the one that was in the All In podcast. Just clips from it. He was talking about nuclear. And I posted that in Telegram. Let's see. And this is what I had to say about it. So, Trump said in that interview with the All In podcast, electricity for AI will double or triple what we have right now. So the AI needs double or triple the amount of electricity that we have right now. So he's promoting nuclear here on this podcast. I think that's very interesting. What I thought of initially was that's what I mean by the cost of AI. So I'm not a big AI guy that thinks AI is going to change everything because it's expensive. And if we're going into a period of deflation, deglobalization, and depopulation, we're not going to have the money, the productive capital to pay for things like double or triple the amount of electricity. We just won't, especially if we want to use it for Bitcoin mining. Bitcoin mining is a much better use of this, and I think will outbid anything for AI because AI has to make a return. Okay, so my example here is if it costs 500 billion for all the currency, for all the electricity, AI will have to provide greater than 500 billion in productivity. And while I'm answering this, let me go back to my website. In the long run, I don't think that it will be able to recoup the cost. I think it will be uneconomic and won't make dollar sense, especially since there will be AI created noise and competition. So, of course, if my country, let's say the US, is trying to pursue this AI and China is in competition with this, why wouldn't they just produce AI that creates a bunch of false information and false signals for the American AI to confuse it? So it's an arms race of electricity consumption, GPU production, and all of that. That's very expensive. For what payoff? Not much if there's going to be a bunch of noise made by your competition. So there needs to have some sort of profitability to this AI, and I just don't see it yet. I mean, I've gone on with ChatGPT and asked economic questions to it, and it gives me some answer, and it's like contradictory within the answer that they give. I tell them to clarify, and it's like, oh, you're right, blah, 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 blah. Oh, but what about this? Oh, you're right, blah, 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 blah. So it doesn't get anything right. Very rarely. It can act like a very expensive Google, right? That's about the extent of what I see, at least right now, using it. Of course, I'm not using it for any sort of high-powered stuff. I'm just using it for my own, local benefit here. But yeah, so that's my thoughts on Trump on the All In podcast and all that. So good to have you here, Delaney. Yes, Dex says only one in BTC that I know of that said they were bullish USD. I think so. I mean, there is one other person in Bitcoin that has talked about deflation, but we need to get the definitions correct here. So, inflation is an increase in the money supply. Deflation is a decrease in the money supply. Prices don't count. You can have an increase in the money supply that leads to decreasing prices. That's what we've experienced over the last 50 years. The elasticity of money. Credit has expanded. There's been a lot of inflation globally, much of it dollar inflation. So money has expanded, but what has happened? Prices have gone down because we've outsourced. We've come up with different technologies. We've funded new things. With this, the return on the credit was high. So we were able to print more money and prices went down. That's counterintuitive to people. And people will, like, the minute you say something like that, they just tune out. They can't put that information into their economic understanding. It's not possible for them. There's also different things like deflation can cause prices to rise. So deflation, a decrease in the money supply, credit contraction, because credit is money today. We have credit money. If credit contracts, there will be less available money for business, for loans, for expanding your business, for taking advantage of some opportunity in the economy. And so prices will tend to rise. Maybe you can't, you start going out of business because there's not money there to tide you over to the next quarter or next year, fiscal year, or whatever the case is. So you can have business failures. All of that is deflationary, but it is also can cause prices to rise. Just like a supply shortage can cause prices to rise. A supply shortage of dollars can cause prices to rise. So you have to get the understanding here correct about inflation and deflation and what they exactly are. But anyway, so yeah, I've been talking about this since at least 2018, 2019, interviewing people on FedWatch and on my, I didn't interview anybody from my own podcast, but on FedWatch, we interviewed a lot of people. And it's just really hard for people they will agree that inflation is money printing, but then they'll turn around and call it price inflation. It's not price inflation. It's just price rises. Rising prices convey information, people. Rising prices convey information. The only time you don't want prices to rise, because rising prices should be neutral, like morally neutral, because rising prices just tell you something about the supply chain, or it tells you something about preferences in the market. It conveys information. We want prices to move, and we want prices to convey information. The only time price increases are bad is when it's due to an increase in the money supply, because it's a distortion in the market. So, yeah. I was the only one talking about that, but there was another person in Bitcoin that was talking about deflation, but they were using the wrong definition, and that's Jeff Booth. So Jeff Booth is a deflation person like myself, except his is price deflation, that there is going to, exponential increases in technology is going to lead to exponentially falling prices, I guess, deflation. But that is not, it's not the same deflation that I'm talking about, not actual inflation. Mine is actual deflation that I'm talking about. Okay, what other comments we have? With all the central banks except the U.S. cutting, are we seeing materialization of the dollar milkshake? John Delaney, very good question. Yes, we are. I mean, they have a dollar shortage. Japan has a big time dollar shortage. And that's why the whole talk about de-dollarization is kind of silly, okay? They don't want to de-dollarize. They are forcefully being de-dollarized. And that's what the milkshake theory is. They are forced to print their own currency to get dollars to service their debt. It's a tightrope. And one country that is kind of immune from this, at least to a high degree, because of a closed capital account, and that's China. they can just kind of extend and pretend and lie because there has been so little access to their actual economy, which is interesting to think about. But that is a sword that cuts both ways, though, because they don't have maybe the biggest dollar shortage problem, but they don't have access to credit either, as well as much as other places. So yeah, I agree with that. Okay. Inquisitive says, how does the US 34 trillion of debt play into your macro thesis, if at all? That's a good question. Now, first off, debt, the government debt, is not money printing, it's borrowing. So it comes from somewhere else in the economy, right? Someone buys those treasuries, gives their dollars to the government, and they spend them. All it does is it redistributes where that demand is being felt. So it, instead of maybe for investments or for um, using that money for private sector lending or something like that, they're lending it to the government. And private sector lending is what we care about, right? Government lending to the government is less productive, it's less efficient. So every dollar that the government gets from issuing a bond is sucking a dollar out of the general economy to go to more productive lending. So that's one thing. It also crowds out um, different types of economic activity and shifts it towards the lower end. Like if it's going out in stimmy checks, that's going to be spent more on material goods and not investment. So it's going to shift the demand structure towards more physical goods, and that's what we saw during COVID. There's a lot of people buying stuff on Amazon, and so the whole demand structure of the economy actually shifted from services to goods. So that can happen as well. But if you're asking if there's a negative effect from the 34 trillion in and of itself, so I don't think so. I think that there is pretty much infinite demand for treasuries. And we see that right now, like, okay, 34 trillion, and we're doing what, a trillion every 100 days. And let's take a look at the 10-year treasury. So remember, we're issuing a trillion. We're issuing a trillion every 100 days, and we're down off the highs by a lot. So first, let's find out how many days since the top. 173 days, roughly. 173 days since the top in the yields. Okay. And yields will rise, and they say yields rise as there's more supply versus demand. So it sells off and the prices go down, yields go higher. But we've printed about 100, what would that be? $1.7 trillion since the high, and we are still way below the high. So they're 15% off of the highs, and it's going lower. In recession, it's going to go lower for sure. So there is an infinite demand basically for this. And but this 34 trillion number, oh wait, I wasn't sharing the right tab. Sorry, guys. So what was I looking at here? Let me measure this out again. So from the top down to here, we're about 15% below the all-time highs, and it's been about 170 days. So the thing is, though, 34 trillion, that's a number of base units. Base units. If you take let's say you take a trillion in treasuries and you put it into the shadow banking system, what happens to it? It gets rehypothecated, it gets lent out in chains of collateral and repo of up to 6 to 7 times. So that 34 trillion is really 100 trillion or more already, if you count all the stuff of rehypothecation in the shadow banking system. What happens when they print more and it's a deteriorating economy? the shadow banking system might shrink. So from 7 leaps, repledges and reuses of a treasury, it shrinks to 6. All right. And in all of that time, or in all those chains of collateral, you could lose $10 trillion worth of treasuries out of the shadow banking system by just losing one link in the chain. And then they issue a bunch more treasuries because people need the treasuries. They need it for their reserve requirements. They need it for funding needs. They need it for repo. They need it for collateral. They need it for all sorts of reasons. And if it's disappearing in a shadow banking system due to a decrease in the numbers of times of rehypothecation, the government can issue a bunch, and it's just it's like goes into a black hole. So 34 trillion, I think right now, I would use it as like a proxy for the health of the shadow banking system. If the shadow banking system was very, very healthy and it could rehypothecate 10 or 20 times, then the government debt would be much lower. But if the shadow banking system is having problems and it's shrinking, actually, the government needs to produce more and more and more treasuries, base units. So anyway, that's what I had to say. I'll get into that more on another one. Okay, so let's see if anybody says anything on Telegram. No more comments there. All right, so the last piece of this macro thesis is depopulation. So let's go into that. Where am I going first? So more births here. Actually, let's do this one first. So this is from Alex Raksha on Twitter, and he is talking about this latest European population data sheet. I'm not sure exactly where this is from. Is this the EU? populationeurope.org. But they have the latest numbers. I think they go out to end of 2023. So end of 2023. These are the numbers. So the Czech Republic, that's this one. They're down from COVID. They've fallen. So they had a little spike here at COVID. And now they've fallen from 1.9, which is good. That's almost back to replacement. They've fallen all the way back down to 4.49. This is not good. Sweden, little bump after COVID, 1.7 down to 1.4. Germany, horrific. After the little COVID bounce, down to 1.3. Portugal is the outlier here. They're up from 1.25, which is absolutely disastrous on a fertility rate, up to 1.55. Remember, 2.1 is break even, and these guys are way below that, even with the uptick here in Portugal, which is interesting. France, down to 1.6. They are the best, I think, in Europe. Let me see what we have here. Yeah, I think they're about the best in Europe, 1.6. This is roughly the US number as well, 1.6. So that's the latest numbers out of Europe. Let's go to another tweet here from More Births. I recommend following him on Twitter, but he's responding to this No Opinion, had a post about Chinese demographics, and he posted this image here, which I think is very, very interesting. So this is the 2024 population pyramid for China. Blue is male, pink or red is female. This where it gets darker up here, this is excess. So there's more females because they have a higher or longer life expectancy. So up here in the older ages, there's more females. But down here, this is the one-child policy. Look at all these extra males. This is not good. There's something like 100 million extra men in China. Something, I don't know, ridiculous. So this actually makes your fertility rate have to be higher to replace because you have fewer females. So let's say you have 45% females, that replacement rate per female needs to be higher than 2.1. It needs to be like 2.4 maybe. So they are farther behind the curve here on population. But this More Births guy, here's what he has to say about this. So he presents this chart, No Opinion, presents this chart to show that China will be fine for a while. He shows the alpha generation is bigger than the Zoomer generation. Okay. And let me go back. Hold on just a second. I need to make this big again for you guys on Telegram. All right. So even if that is true, both the Gen Z and Alpha are smaller than Gen X and the Millennials. So the workforce will shrink. Okay, true. But I don't believe these numbers. Let's see what else he has to say. But the alpha bump in China may not be real. Demographer, this guy, I think his name is, Yi Fujian from, he is from Japan, I believe, notes that Smith uses UN projections, which vastly overestimate Chinese fertility. He persuasively argues that the bumper crop of Gen Alpha in China is illusory because China inflated birth numbers until recently, just like all of their economic numbers. China's demographic problems are severe for many other reasons. One, China's real estate market is the world's biggest asset class. Maybe not now because it's shrank so much in the last couple of years. Worth more than the whole U.S. stock market at its peak. And the country is already depopulating. Imagine the wealth destruction. Chinese young people have increasingly low fertility intentions. That's important. Just 1.6 children on average. So if you ask a Chinese youth, say a young adult, what is their intention on the number of children they want, the average is 1.6. Oh my gosh, that's so bad. That means your population will halve in a generation. Since realized fertility tends to be substantially lower than intended fertility, it is likely that China's total fertility rate is heading towards South Korean levels. Absolutely, if it's not already there. We don't even know. Okay, China housing presents a huge hurdle to demographic turnaround in China. Pictured below are apartment towers in Shanghai and Tianjin. Such ultra-dense apartment blocks are associated with extremely low fertility and will drag the Chinese TFR down for a long time. So if your people are in high-density areas, it's very, very bad for your fertility rate. And this is the housing that they built. Okay, so to unwind this density, they would need to completely revamp the way that they are living. And they just don't have that opportunity. Their labor force is shrinking. Their credit markets are deteriorating. Their housing market, which is a third of their economy, is crashing. There's just no way to re-engineer this whole system without massive pain. We're talking revolutionary pain. Okay, moving on. No matter what China does, the number of births will be depressed for at least the next 30 years because the shortage of women due to the one-child policy. The sex ratio peaked at 120 boys for every 100 girls. Wow, that is pretty bad. Returning to Noah's chart, fast forward to 2050 and note that the cohort size will only be 1/3 as big as the one retiring. So as the millennials go up, it's getting replaced by smaller and smaller cohorts. It'll be steeper drop than Japan has been experiencing. All right. Given the effect of decaying demographics on the economy, which I discussed in a thread, this seems almost impossible for an aging, shrinking China to escape bad outcomes. So it's a reinforcing thing. That's what I started with this episode here, talking about the reinforcing factors of deflation, deglobalization, and depopulation. They are reinforcing factors. And Bitcoin is really the only way to stop the deflation. So stop the feedback loop on itself. Because the deflation is not coming from money printing and yada, yada, yada. It's coming from credit collapse. Credit collapse. Well, Bitcoin does not have counterparty risk. It is not based off of credit. And so it can be used to stop the deflation, backing the dollar or something like that. So that is the key to stop this feedback loop. All right, I have one more thing here. He mentioned that demographer. And here is a from the Japan Times. And here's this guy, Yi Fujian. And he's talking about the overestimate of population in China and India as well. The main part is India, and then he also talks about China. But this is, let's see, the World Population Prospects WPP report. That is the UN's report. And here he's talking about 2022, and this was published middle of last year, about a year ago. So maybe they have another report out for 2023. But here we go. According to India's recent census data, the country's population stood at 1.03 billion in 2021 and 1.21 billion in 2011. The WPP report, however, put these figures at 1.08 billion and 1.26. So not a huge discrepancy. But look, that's how much more is that? 50 million more. So that was off. The 2001 was off by 50 million, and this one was also off by 50 million. Moreover, India's National Family Health Survey indicated a fertility rate of 1.99, so below replacement. And the WPP's estimate was 2.16, above replacement. So this WPP is is overestimating the Indian population by a significant amount. All right, and this goes into that in more detail, but let's go down here to the Chinese demographics. So the WPP, again, that's the UN's projections of Chinese demographic trends, are even more exaggerated. For example, the 1992 UN estimate that China's population will reach 1.54 billion by 2025. Well, that didn't happen. While the 2022 report revised this figure down to 1.42 billion. The actual figure will likely be closer to 1.27 billion. So that is a huge miss. From 1.5, this is what they anticipated back in 1992, down to the real number of 1.27. So, and that's a big miss just from the 2022 report to the actual figure. So 0.42 to 0.27. I mean, this is a humongous miss. Likewise, the 1996 report projected that the Chinese population will increase to 1.52%. Oh, Jesus. 1.52 billion by 2050. But the 2008 report revised this forecast to 1.42. And the 2022 edition further reduced it to 1.31. When it comes to 2100, the 2019 UN report projected a population of 1.06 billion. That's a third. But the 2022 report adjusted this to 767 million. Half of this projected number, half. These constant revisions have undermined the trustworthiness of UN demographic data as a source for insights into Chinese socioeconomic trends. Nevertheless, China's official demographic figures are heavily influenced by US projections. China's official demographic figures are heavily influenced by UN projections. Zhang Weiqing, sorry about that. The former director of China's National Population and Family Planning Commission confirmed that in 2006, that it's heavily influenced by the UN projections. I mean, that's commonplace with communists, though, right? They have quotas. Go out and produce this much steel. Go out and produce this much rail. Go out and produce this many high-rise apartments. You have your quota, go do it. And it gets done, even if it's subpar construction, even if it's not needed, even if it's a bridge to nowhere. So here they're doing the same thing. The UN just set their goals. So the UN set their goals. The projections are by 2022, you're going to have 1.42. And what are the official Chinese numbers? Oh, we have 1.42. Uh, a former deputy director of demographic and social statistics at the UN's Statistics Division has been overseeing China's census since 1982. Should India's 2024 census reveal that its population is significantly smaller than the UN's projections, the reliability of the report's projections for still other countries would be called into question, further discrediting the survey as a credible source for studying the world economy. In addition to overestimating the populations of China and India, the UN has financially supported both countries' population control policies. In 1974, the UN Population Fund provided India with 40 million, and then Prime Minister Indira Gandhi introduced a series of radical measures to manage the country's population growth, resulting in the forced sterilization of roughly 8 million Indians. Fortunately, voters removed Gandhi from power in 1977, leading to the abolition of these policies. After India, the UN, what does that stand for? Population Fund shifted its attention to China, providing 50 million in 1979, a substantial sum given that China's foreign exchange reserves at the time totaled just 167 million. The funds were used to, and this is before opening up, I think. Didn't they open up in 1980? So this is even before opening up. The funds were used to implement China's one-child policy. Oh my God. Oh boy, that's bad. Under the iron fist of health minister, this guy, sterilizations soared from 2.2 million in 1981 to 20.7 million in 1983, and abortions surged from 8.7 million to 14.4 million. They present this fund, UN Population Fund, presented its first UN Population Award to Gandhi and Kwan. I don't know who this one was. Did they say up here? Yeah, Minister Kwan of the Health Minister of China in recognition of their contributions to population control. I mean, how sick is that? So anyway, this is talking about the overestimation of their population. I've also seen studies from China about like salt consumption. People from Russia and Japan have estimated the amount of salt consumption in China, and they said there's no way that there's the amount of people that they say there are. They're overestimating by 100, 200 million people even. So anyway, that is the depopulation piece. So let me check the comments and see if there's any other stuff here to talk about. Oh, John Delaney, you said he talked about the WHO. I didn't hear that part. That you're talking about Trump. I didn't hear that part. Okay. John Delaney says, considering the electrification of war, do you think that China is reducing its population on purpose, since all they need is really a few engineers and a bunch of metal extractions to produce drones? No, I don't think so. They, first off, well, I don't know if they know this, but they probably do. If I know it, they probably know it. If you have demographic decline, you actually get a reverse specialization. That's one of the worst parts of demographic decline, I would say, is that so now you have all these different types of medical doctors and they all have their specialties, and you can find maybe 10 doctors in a large metropolitan area in each tiny specialty. Well, as population starts to go down, you start to lose that specialization. Maybe in 10 or 20 years time, maybe 20 years time, you might only be able to find one doctor in each specialization. So, the demographic decline starts making specialization go away. And that is not just in those big fields. It would also be in every field, in every different sector. You're going to lose specialization as population declines, especially think that these numbers have China's population dropping in half by, in the next 75, 80 years. Half. That's a lot. By definition, you're going to have to lose a lot of specialization in your economy. So I don't think they would do that, but they are communists, so they do think that they are very good central planners and that they can do anything. And if they don't do anything, they'll just kill you. If they can't do it, then they'll just kill enough people. Inquisitive says, what is causing the credit-based money to lose its effect now? The deglobalization recently seems fairly political and could theoretically be resolved very quickly. And the demographics issue is a much longer term issue, as you say. Well, it's happening right now because of diminishing marginal returns. So diminishing marginal returns on debt. So every dollar that is created through credit expansion, in the old days, say in the early 80s, it would maybe make $4 or $5 of GDP. It would be hyper productive. And then after that waned in the United States, you could go to Japan. That ended in 1990. Then you could go to China. And then you could take out, you could expand the credit-based system and get a lot for every dollar of expansion. Now that is diminishing marginal returns. It's less and less and less. It gets to the point where it comes under 1. Now I think the numbers out of the U.S. are like around half. So it takes $2 or $3 of debt to create one positive dollar of economic growth. And in China, I think it's about the same, like 1/3. So this is diminishing marginal returns sets the clock. Eventually, you're not going to get anything. It's going to be pushing on a string. Credit creation, everyone's going to say it's so inflationary. Look how inflationary this is. Where government debt, or let's say even the Fed balance sheet or government debt is up to 100 trillion. There's going to be so much inflation, guys. It's crazy, but it won't be. The reason they're doing that is to try to get economic production. They're just trying to delay the deflationary collapse, and eventually it will be a deflationary collapse. All right. Yes, and John Delaney, you are correct as well. You say the precursor credit-based equals trust-based. Yes, that is true. As trust breaks down, that adds to that, and it's reinforcing. But the initial kickoff is diminishing marginal returns. Okay, Inquisitive, you say, we've had lots of wars going on in different places ever since 1971, so that can't be due to the recent wars. Yeah, but they haven't been wars between great powers. I mean, the U.S. went into Iraq, remember, the 4th largest military in the world, and beat it up overnight. And so there haven't really been any big wars. I mean, you say that we've been in people would say we've been in Afghanistan for 20 years. I served in Afghanistan, but that wasn't like a war. That was more like a regime change operation, a government building operation, more than it was a war. So you're using the military to do a cultural thing, and it didn't really work, right? But no, the U.S. There haven't been any wars against great powers until this Ukraine. Well, first the Crimea conflict in 2014, and then this Ukraine thing now. So, that's directly pitting. I mean, there are NATO troops, ununiformed NATO troops in Ukraine. I would say that's a significant majority of any sort of stiff resistance that they're offering over there is ununiformed NATO troops. But then that's a guess. That's a total guess. But yeah, that's what I would say. Theoretically, if global trust is repaired somehow, then could we return to another 50 years of credit-based monetary expansion? No, for the reason I said, there's diminishing marginal returns, and we're getting to the end of that, and it starts to become a zero-sum game, right? So as you as there's a dollar shortage, everything becomes zero sum and trust breaks down. People's trust in their governments break down. That's why we're seeing a hard shift to to conservative parties, because they're more nationalistic, and they have a different type of idea about zero sum or growth, or they're like, let's get our own house in order. We don't want to get taken advantage of by other people. We don't want to take care of everybody else. We want to do our thing and take care of our own people. So it's a zero sum game. They don't want to share their cake. Okay, so that's all those comments. Thanks, guys, for listening. I'm going to sign off for the weekend. So hope you guys had a great week. Hope you have plans for the weekend. And check out bitcoinandmarkets.com. That's my website. Sign up for the free weekly newsletter. You can also support my content there as well. bmpro.substack.com for the Bitcoin Magazine Pro. At Ansel Linder on Twitter. And what else? If you're watching on YouTube or Rumble, like, comment, subscribe. If you're not, if you're watching on Twitter, jump over to YouTube or Rumble, subscribe, please. Trying to get the subscriber count up so I can monetize the channels. But all right, guys, appreciate you, and I'll see you on the next one. Bye.